What is bad debt expense and how do we calculate it? I'll talk about that in this video. My name is Katherine. I'm a CPA and your accounting tutor. I help accounting majors like you through graduation and beyond. Bad debt expense is the expense of loaning money to a customer and accounts receivable that they never pay. The truth of bad debt expense is that it's really incurred the moment we let the customer who will never pay walk out of our store with merchandise. The problem is we don't know who it will be ahead of time. Otherwise, we would never have extended them credit in the first place and let them leave our store with stuff without paying. Since we don't know for sure who won't pay or how much money we'll lose, we have to make an educated guess about it. This guess would be based on either our own direct experience with our company and our customers or a reasonable number for our industry. There are technically two ways of dealing with this, the direct write-off method and the allowance method. In the direct write-off method, we debit bad debt expense and credit accounts receivable at the time of write-off. We've been reaching out with letters, phone calls, emails, any way we can, and while they still legally owe us this money and we would love to collect it, we want our accounting records to be as accurate as possible. We no longer truthfully expect to receive this money, which is when we write it off, something like 6 to 12 months after it was due to us, depending on the company. To create the bad debt expense at write-off, debit bad debt expense, credit accounts receivable, so long after they originally owed us the money, breaks the matching principle, and isn't GAAP compliant. We won't spend any more time talking about it. In the allowance method of handling bad debt, we make a guess every month about how much of our accounts receivable will be uncollectible and make an entry to debit bad debt expense and credit the allowance for doubtful accounts. Allowance for doubtful accounts is one of those super weird contra accounts. In this case, it's a contra asset paired with accounts receivable. It shows on the balance sheet with the assets, but as a negative since its normal balance is a credit. You can think of allowance for doubtful accounts or allowance for uncollectible accounts, as your class might talk about it, as a holding account. We don't know who won't pay us or how much money we won't collect, and the allowance is a holding account with our best guess. We debit bad debt expense for the amount we think might be uncollectible and credit allowance for doubtful accounts. To figure out the amount that might be uncollectible, broadly speaking, we have two choices. Option one is called the income statement method, and we calculate it based on a percentage of credit sales, and we get that percentage based on our business experience or our industry. For homework purposes, it'll always be given to you, something like 2%. We take credit sales for the period, multiply by 2%, and that's our number to debit bad debt expense and credit allowance for doubtful accounts. We're done in one step. Option two for calculating this number would be a balance sheet method, and there are two common types. Type 1 is a percentage of accounts receivable, and type 2 is based on the accounts receivable aging. The most important thing to note with both balance sheet methods is that it's a two-step process. In step 1, we figure out what the number in allowance for doubtful accounts should be, and in step 2, we find the difference between what it is and what it should be and make the entry for the difference. If we're using a percentage of accounts receivable, we'll get a number such as 2% of all accounts receivable. Step 1, we multiply the current balance in accounts receivable by 2% to find the balance that we want to have in our allowance for doubtful accounts. Importantly, we always want our allowance to have a credit balance because it's a contra asset account with a normal credit balance. Step 2, we compare that number to what it currently is. If, for example, we want the allowance to have $1,000 in it and it currently has a credit balance of $200, we do 1,000 minus 200 to get an $800 adjustment we'll make, debit bad debt expense for $800, credit the allowance for doubtful accounts for $800. Another important note, our math changes if the allowance for doubtful accounts currently has a debit balance. In that case, we have to add the numbers together to get the amount of the bad debt expense instead of subtracting as we just did. Let's say, for example, instead of having a $200 credit balance, we had a $200 debit balance. To get our allowance to the $1,000 credit balance we want, we have to credit $200 just to get to zero, then another $1,000 to get to the required $1,000 credit balance. So we add them together. $200 plus $1,000 equals $1,200 bad debt expense. Very important, always pay attention to whether the current balance in allowance for doubtful accounts is a debit or a credit. The second type of balance sheet method is based on accounts receivable aging. In this situation, they'll give you an aging like this, which shows how long various amounts have been outstanding for the company and what percentage of each aging bracket they think will be uncollectible, again, based on either our own experience or industry standards. For purposes of homework, they'll always give it to you. The percentages go up the older the accounts receivable is, which makes sense if you think about it, because the more time has passed since the bill was originally due, the less likely it is that the customer will ever pay you. In this situation, you'd multiply everything across, the dollar amount times the percentage uncollectible, and then you add up those totals to get the amount that we want our allowance to have, credit balance. Again, we compare that number to our existing balance, subtract them if the existing balance is a credit, and add them if the existing balance is a debit. Debit bad debt expense, credit allowance for doubtful accounts for that number we just found. When we do ultimately figure out who won't pay and decide to write off their balance, probably 6 to 12 months after it was originally owed to us, and we did our best to collect it, we write off the uncollectible balance by debiting allowance for doubtful accounts and crediting accounts receivable for the amount of that person's specific balance. This keeps our net accounts receivable the same as it was before. For example, if we had $1,000 in accounts receivable and a $200 allowance for doubtful accounts, our net accounts receivable then, 1,000 minus 200, is $800 net accounts receivable. If in this example we write off $100 worth of accounts receivable by, again, debiting allowance for doubtful accounts and crediting accounts receivable, each for $100, then our accounts receivable would have a $900 balance and our allowance would have a $100 balance, which they still net together. 900 minus 100 is $800. So as you can see, our net accounts receivable does not change. That's sometimes a homework question, so important to know. Remember that our monthly entry for bad debt expense is always a guess, so it could end up with an irregular debit balance if we had been guessing too low and ending up writing off more balances than we had expected to. That would be a good signal to us as a manager that we should start increasing our expected uncollectible amounts, tighten up our credit requirements for who we decide to extend credit to in the form of an accounts receivable or some combination of both. That's it for this video on bad debt expense. Let me know if you have any questions in the comments. If you want a free cheat sheet to help you keep debits and credits straight, you can find it linked in the description. And I'll see you in the next video. Bye.